All right, hello, ladies and gentlemen. My name is Greg Michalowski. I'm the Chief Currency Analyst for FXDD, and welcome to this special FX Street webinar. I don't know if it's special, but I think they call it featured or one of the featured. But the point is, I'm happy to be here, and I hope that you're happy to be here as well, participating in what I hope to be a thought-provoking, if not life-changing webinar titled "Having the Mindset of a Forex Trader." What is the mindset of a Forex trader? I'm going to go through it, and it's not going. It may be daunting at times for you to understand what it means to be a Forex trader, have the mindset of a Forex trader. But anyway, we'll work our way through it. Today's date is February 19th. It is the year of 2013. Again, I'm the Chief Currency Analyst. My Twitter account is CraigMikeFX, and you can also follow me live on livestream.com/FXDD. Let me remind everybody before we start that trading foreign exchange is risky, that you stand to lose all or part of your risk capital in the foreign exchange market. In addition to that, leverage increases or creates additional risk and loss exposure. So if you be sure to take that into consideration and understand that you can lose all or part of your risk capital in the foreign exchange market. That's what this disclaimer is about. I need to show that. I need to find it. So I found it now. It was before my live one, or my prior slide. So take a moment, take a look at this disclaimer, understand it, understand that I'm not here to give buy, sell, or hold recommendations, but it will try to educate you as far as the mindset of a foreign exchange trader. So who thinks trading foreign exchange is easy? And if I was in a live audience, I would have no hands go up. I would imagine that. In fact, I've had people tell me, very smart people, doctors, lawyers, engineers. Not that that they cover all the smartest people in the world, but certainly people who were at the top of their professions, whatever profession that may have been, that took a lot of education, a lot of learning, have come to me and said, trading foreign exchange, I am a doctor, I am an engineer, I am a nuclear, whatever their field is one of the hardest things they have ever done. Trading foreign exchange is simply not easy. It's not easy to trade foreign exchange, but a lot of things are not easy as well. For me, hitting a golf ball straight and consistently straight is not easy. For you American people or you soccer people making the NFL playoffs or making the playoffs in whatever league you're in, or continuing along in the FA Cup or whatever, it's not easy. Winning the Super Bowl, we just had the Super Bowl here in the United States, only 3.1.25% of the team, that's the chance of you winning the Super Bowl with all the teams that are in the NFL. So it's not easy. Owning a restaurant after 3 years, not easy, only 40%. Getting into Harvard University, in 2010, 6.25 of the applicants were accepted into Harvard. That's it. It's not easy. How about graduating from college? These are U.S. statistics, by the way. Only 27% of the population in the United States here graduated from college, according to a recent study. Getting a master's degree, only 10%. Staying married, 40% divorce in the United States. Not an easy thing. Staying married. Raising children, those people who raise children, is not easy. Saving money in this day and age, not very easy. And getting anything done in Washington, certainly not easy. I think that put that at around 0% chance. We have to have sequestering and stuff like that. Automatic spending cuts. How sad it is. But these are things in life that are not easy. But difficulty has never stopped me, and I don't know about you, but it's not been a barrier for me for the most part. Now, I'm not going to go rock climbing. I can't rock climb. I don't want to go rock climbing, but just because it's difficult doesn't mean that I want to go and do it. But most of the things in life, things that involve involve an effort where I have a passion toward. It's not stop me. And if you have a passion toward trading foreign exchange or a desire to trade foreign exchange, just because it's difficult, if you have a passion, go for it. Try to get through it. When the going gets tough, the tough get going. And it's not. There are very little barriers to the foreign exchange market. It's just a matter of you getting over those humps, understanding certain things about the foreign exchange market that you need to know in order to be successful. Now, in her book, Mindset, Carol Dweck wrote about how people tend to have one or the other type of mindset. This is a good book, by the way. It's not about traders' mindsets. It's about having the mindset in life and all. But I personally believe that life is trading is a microcosm of life. They're very similar things that you have to do to control to be successful in life, and the same thing goes true for trading. So I saw this book and I started reading it, what Carol Dweck says is that there are two types of mindsets that people have. One is a fixed mindset. Fixed mindset is one whereby, I'm going to give an example in the real world, where someone gets a C on a test, an average grade on an exam, and that student, instead of or takes the approach that, well, there are some questions on the exam that really weren't in my notes, or it wasn't in the book, and it wasn't in the questions that she gave us, or the review questions that she or he gave us for the test. And it's really not fair that those questions were given to us. And so, I got a C on the test. So this type of person with a fixed mindset is, give me everything and I will follow along as much as I can. But if I have to think outside the box, or I have to, or if there's some little trick in this test, I'm not gonna be able to answer it. If I have to use critical thinking, that's not part of the test. So that's what a fixed mindset person is about. Now, compare and contrast to someone who has a growth mindset. A growth mindset person will look at that same test and look at the same grade at a C and say, what do I have to do to get better? There was some questions on there that I really didn't prepare for. They required me to think critically about the topic or the topics and apply deduce what the solution would be or whatever to it. And so this type of person with a growth mindset will start to think outside the box, start to expand their mind, try to figure out ways that they can make themselves better. So although trading is difficult, you have to have the right mindset to attack it. You cannot have the fixed mindset. You have to have a growth mindset to attack it. And if you don't, you're probably going to be mired in the world of C's or less on your report cards for trading. If you have a growth mindset, however, you're going to be working your way up from a C to a B to perhaps an A+ trader, and that is what I'm going to focus on here, on having a mindset of a foreign exchange trader. What do you need to do to develop to get going? And you need to develop and understand the growth mindset of a trader. What are the character traits of a trader? What are they thinking, and how do they act? And I want to go through them right now in a list format, and then I'll talk to them about them individually, and maybe go back and take a look at some charts and apply them in a real world situation here. But it's a lot of I want you to get your arms around this important foundation of what you need to think, how you need to have a mindset of a foreign exchange trader. And quite frankly, the list is going to be a little bit surprising and a little bit intimidating at first, but I hope that when I go through each of the parts of it, that you get the understanding of what I mean by having these mindsets. So let's get into them. And I have a list of let's see, 1, 2, 3, about 6 or 7 of them. So let's start off with what kind of mindset do you need to have as a foreign exchange trader. And the first one, you'll get the idea of what I mean by a little bit intimidating and a little bit intimidating to you. First mindset you need to have is you need to be disciplined but aggressive too. Disciplined but aggressive too. Greg, you're asking me to be everything. You're asking me to be disciplined and aggressive too. But when I get to the details of it, you'll understand it. You need to be a loner, but you need to be a crowd follower too. You need to be a winner, but you're going to be a failure too. You need to anticipate and be an anticipator of the future, but you need to focus on the past and the present too. You need to be a devoted, quote-unquote, lover, but a swinging bachelor too, or bachelorette, if you will. You need to be a fear conqueror. You need to conquer your fear, but you need to be a greedy bastard too. You need to be a risk taker, but you need to be a risk avoider too. Now, I know what you're all probably thinking is like, how the heck am I ever going to be all these at the same time? How can I be disciplined and aggressive? How can I be a devoted lover but a bachelor too? How can I be a fear conqueror but a greedy bastard, a risk taker, a risk avoider at the same time? It seems like you're asking me to be everything, Greg. And my wife, I love my wife greatly, but she's a big proponent of this personality test called the Myers-Briggs personality test. And I don't know how many people out there are familiar with this test, but it's supposed to bucket you, I guess, in a character, bucket you into the characteristics of you yourself as a person. And they use things like introverted and extroverted, and someone who uses their senses, and the other opposite is using their intuition. But anyway, there are 8 different categories. Well, there's 4 different sets, I guess, or 4 different combinations, and then with a total of 2 in each, and there's 8 total. And so if you were to take the Myers-Briggs personality classification for a Forex trader with those ideas of what the mindset of a Forex trader should be, I think a Forex trader would be characterized as an introverted extrovert who uses senses and intuition in his thinking and feeling while using judgment and perception of valuing trading opportunities. In the words of the Myers-Briggs, I would be an IESNTFJP. That is the initials for each of these groups. And quite frankly, as a personality, you only have one of each of these 2. But a foreign exchange trader has to have all these things. They need to be an introvert and extrovert. They need to have senses of the market, but they need to use their intuition. They need to think, but they also need to feel. They need judgment, but they also need perception. You need it all. You need it all, my friends, to become a foreign exchange trader. Sounds daunting, sounds impossible, doesn't it? But let's simplify things. Let's bring things back to the present situation and take a look at each of these in and of itself and try to understand what the mindset means to be disciplined and aggressive. What does it mean to be a loner and a crowd follower? What does it mean to be a winner and loser? And go through each of them separately, and then get your arms around them. Get your arms around what it means to be these things. What does it mean to be disciplined and aggressive? So let's take a look at discipline and aggressive. Forex traders, in my mind, need to be focused on being disciplined to the point of being boring. To the point of being boring. Typically, a successful foreign exchange is not going to wander far from what is normal for them. If the market is not behaving correctly, they'll even choose not to trade. There is that choice, folks, of not trading, okay? You don't want to force yourself into an undisciplined trade just because you're trading. So you have to be so boring that you are so disciplined in what you do that it becomes boring in what you do. Let's talk about the mindset of a loner, but a crowd follower too. What do I mean by that? Well, trading, my friends, is a lonely endeavor. Not only do most traders sit in the office, we sit in our office by ourselves, but each and every one of our positions are owned by ourselves. We have to make the trading decisions for ourselves. I'm one who think that trading is not about buying an EA. It's about you don't know what an EA or an expert advisor is going to do for you. Trading is about understanding that what you need to do, how you need to do it, what your trading style is, where you can define risk and limit risk, and that's what trading is about. So you yourself, as a trader, own your position. You own every one of your positions, whether you buy or sell. You need to conquer the mindset of being a loner. It's tough being a loner, being by yourself, being there, and you're the only one in charge of it. In our lives, most of the time, we rely on other people. We rely on teams. Trading is not about a team. It's about yourself. But you also have to be a crowd follower. What do I mean by crowd following? And for most retail traders, for all retail traders for that point, the important thing to recognize is that you are not in control. You are not in control of pushing the market either to the upside or to the downside. You are purely a parasite to the quote unquote market out there. And I put that in or quotations marks. You are therefore have to be a crowd follower, and you have to follow at the right levels. And if you benefit, and if you follow at the right levels, at the key technical levels, I like to find, and I wish I could show you my charts, but I can't. You take advantage of the market's bias. You follow along with the market. And so we cannot, as an individual, as a loner, as a trader who's taking our own positions for ourselves, cannot move the market. We cannot move the market. We are at the mercy of those who can. So what we have to do as a trader is be a crowd follower and use technical tools that are going to be there to define your bullish or bearish bias. And so once you take your ego and park it at the door, and start to instead focus on the fact that you are a crowd follower, then you take the mindset that I love those big guys who move the market, and I don't blame them for moving the market, for taking my money. Instead, I'm going to be the crowd follower that follows along with them. So if the price moves above a trend line, I'm going to be a buyer above that trend line. If the price moves below a moving average line, I'm going to be a seller through that moving average line. Why? Because it's turning the bias from bearish to bullish, or from bullish to bearish. And those are the clues that the tools apply. When they apply to the price, they give you those clues that allow you to follow in the market. Does the market always go down once it breaks a moving average, or go up once it breaks a moving average to the top side? No. But those technical tools end up defining your risk and limiting your risk against those levels. That's why I use certain technical tools that do that. I want to use a tool that's going to tell me what the crowd is doing. That if the price moves above it, it's going to be bullish, and if the price stays above it, it's going to remain bullish, and I'm going to follow along with the crowd. So as a trader, you need to be a loner. You have to be one that's going to be able to do this by yourself, to conquer that mindset of being alone all the time, being in charge of everything that you do. But you also have to be a crowd follower too, and understand that you are not in control of the market. It's not anything that you do or think or whatever that causes you to make money. It is the market agreeing with what you think. And if the market agrees with what you think, you in essence become the crowd follower, and you have to follow the crowd and hope that the market does what you think. All right, growth mindset. Number 3, you need to be a winner but a loser too. If you don't have a winning mentality, you're never going to win. All right. If you have this mentality that I'm going to lose on every trade, that you cannot, that as soon as you put the trade on that to go long, that you decide you want to go short, or you feel that you're going to be short because you're going to lose on this trade, you're never going to win. You have to have a winning mentality. You have to, and winners should make you feel good. You should have a feeling of accomplishment as well. But understand as well that that once again, that the winning on any one trade is not anything that you did. It is the result of the market agreeing with what you did. And so being a winner is not is about being humble and thankful rather than boastful. And the reason why you do this is because it's more business-like. You're going to have, in a business world, in a business environment, you're going to have winners and losers as well. But you cannot get too high on your trades. You cannot get too low on your trades. And the reason is because you have to keep yourself calm. You have to keep yourself steady. You have to keep yourself thinking positively about what you do, but understand that you're not really in control of your winners. The market is, and that you're just happy and humble that you made that win. And the other reason why you have to take that attitude is also because you're going to lose plenty of times in the foreign exchange trading. You will not always win. You will fail and fail and fail and fail. I've had traders come to me and say they've fail 60% of the time, 65% of the time. They're only right 35% of the time. You have to get your mindset set that losing is a part of trading. That losing is going to happen, and it's going to happen often. That the market is not going to do what you thought it should do when it broke above the moving average or it broke below the trend line. You have to accept that those losses, and you have to accept the fact that those losses, or accept those losses quickly. The faster that you can accept the losses, understand that your loss, that the market isn't doing what you think it should do, the better off you're going to be as a trader. So you have to have that mindset of being a winner, positive about what you're doing, understand that the market is really in charge of your position, but if the market agrees with what you say, take that winning and ride that winner. But if the market is, if you have to also have the mindset that you're going to lose, but if you start to lose, if you lose on a trade, if the market doesn't do what you think it should do, if it breaks above that trend line and then moves back below that trend line, get out. Don't waste your time. Just get out. Risk a little, make more than a little, keep your trading capital, and stay in the game longer. That's what losing is about. That's what the mindset of losing is about, is taking your losses, taking them like a man or a woman, and taking them as quickly as the market tells you that you're wrong, because you're not in control. The market's in control. The next growth mindset of a Forex trader is that you need to be an anticipator of the future, but with a focus on the past and the present too. You have to be an anticipator of the future, but the focus on the past and the future as well. What do I mean by anticipator of the future? Every successful trader in their mindset is looking ahead, is thinking ahead about what may happen. And I want to bring you to a parallel to, let's say, an athlete. Okay, all successful athletes, they look ahead. They're able to see the future from what is in front of them. Think of a soccer player. A soccer player comes down the pitch with the ball, and over to his left is one of his players and defenders. Over to his right is another player and defenders. He has to have a level of anticipation of what his player will do, what the opposing player will do, to his left and to his right. And a successful play or a successful attack of the goal, whether it leads to a goal or leads to a shot on goal, it doesn't really matter. Both of them are successful in what you do, and eventually you're going to wear away and score some goals. But a successful movement on the soccer pitch is a culmination of those players all anticipating what each other is going to do. Not only the player with the ball, but the guy on the left, the guy on the right wing have to anticipate what the guy who has the ball is going to do as well. And that is what traders need to do as well. Traders need to be an anticipator of the future. How do you anticipate the future in trading? By looking at things like retracement levels. The market is trending to the upside. The market corrects 38.2 to 50% of a trend move to the upside. Imagine in your mind, okay, I know you're not seeing the picture, but imagine in your mind, market corrects 38.2 to 50% of that move to the upside. You're anticipating that the market will bottom against that level, bottom against that what I call correction zone in that against those retracement levels. You're trying to anticipate what the market will do next. It will move higher off of that level. You're trying to get good to great trade location where risk is defined and risk is limited. You are trying to anticipate the future by looking, by anticipating the future of what of your trade. That is important mindset to have as a trader, is to be able to anticipate what may happen in the future. So you need to see the future before it happens. You also have to be a focus on the past and the present. And if the future, or if the anticipating the future was your vision, okay? That vision, although it's you have in your mindset what the market may do. If the market holds a 38.2 to 50% retracement, the market's going to continue to go to the upside. But you don't know how far that market is going to go to the upside. You don't know if it's going to break a new high and make a new high by 1 or 2 pips and then reverse back to the downside. The future vision of traders is more blurry than the past and the present. The future of a trade is more blurry than the past and the present. And so I find it kind of ironic that when most people talk about a trade, I'm putting on this trade and I think the price is going to this level, I'm going to buy the euro at 133.57, and I see the price going to 134.25. I find it kind of hard that, I find it if the future is more blurry, then how are you so sure that the market's going to go to 134.25? You're not, you're really not. You're just kind of guessing at it. But what does the past and the present tell us? And the past and the present gives us a more clearer picture, a more focus on our vision. Okay, we can look at a chart and take a look at the against the 38.2 and 50% retracement. Where does that retracement level come from? It comes from the past and the present. We take a swing low, and go to a swing high. We put a Fibonacci on it, and we calculate the 38.2 to 50% retracement level. That is all off the past and the present. And what we get is the retracement level, a level where we look to buy the market. We're going to buy the market against the 38.2. We also know that that retracement level is also a way for us to define our risk. If the market moves below the 50% or below the 61.8% retracement, we can get out. So the past and the present is important in that it allows us to define and limit our risk. And that reward that most traders look at, the market going to 134.25 or 134.50 or 135 or wherever it's going to end up, is going to come if the market agrees with us. So as a trader, you have to understand the thing about anticipating the future is that it's important to anticipate the future because that gives you confidence in the trade, gives you a confidence of where you're going, how you're going to get, where you're potentially going. But that vision or that reward is more blurry. So understand that mindset is more blurry in your trading, but also understand that the good news about trading and about using technical analysis in particular is that the past and the present allows us to define when we're wrong. So the rewards are kind of fuzzy, but the risk is clear as can be. And if you have that mindset that the focus is on your risk first and let the rewards happen, you're going to see the market more clearly. You're going to have a clearer mindset about how you as a trader can approach and attack your trading. All right, the next mindset that I think Forex traders need to have is that you need to be a devoted lover but a swinging bachelor too. A devoted lover but a swinging bachelor too. Trading trends require being a devoted lover to the position. And let's face it, that if you do not devote yourself to a position, you'll never really trade a trend. the trade will likely be closed out way before the trend is complete, or way before before the whatever the swing high occurs or the swing low occurs. It'll never ever happen. So traders need to have in my mind, trends are where the most money is made in trading. Trends are fast. Directional tend to move in a larger trading range than normal. And so if that is true, and to me it's a definition of a trend, fast directional move in a larger trading range, that's where I have the ability to make the most amount of money. And for all traders, if you don't have that desire to make the most amount of money, then why trade, So I'm focused on trying to make the most amount of money. Where do you do it? In trending markets. So traders who focus on trending markets or the potential of a trending market, they have to be a devoted lover to the position. And if they are, they have the ability to catch more trends and stay on the trends. That's where the most money is made. So how do you stay devoted to your position? How do you stay devoted to the trend that may or may not happen? And how do you know that the trend is continuing? How do you stay? And the way you do that is by using, again, the technical tools that are going to tell you that this trend is still positive. If the market corrects and stays above the 38.2 to 50% retracement level, is the trend still continuing? Yes, the trend is still in the direction of the market. If the market stays above a trend line, is this trend still continuing? Yes. So being a devoted lover to a position is a mindset that you have to have that in essence says, market, tell me when this trend is over. Tell me when this relationship is over. I'm not going to end this relationship until you tell me it's over. So you're putting the burden of this relationship, if you will, in the market. And that's the way a devoted lover, a devoted trader, that's what I mean by being a devoted lover in trading. You have to have the mindset that you're going to let the market tell you when the trend is over. And when the market tells you that the trend is over, you get out. You get out of that relationship. You get out of that position, and you get out. And you square everything up and you take your profit. So you have to be a devoted lover if you're ever going to trade the trends in the foreign exchange market. Now there are times as well when when the market requires being a swinging bachelor as well, a bachelorette. Where there are times when you don't want to fall in love with the market, you want to fall in like with the market. During these types of markets, the market is swinging from a ceiling to a floor, from a ceiling to a floor. And what we've done over the last 3+ days until I think just right now, when the market is broken to the upside, outside of the trading range for the last 3 days. But if you take a look at the last three trading days in the euro versus U.S. dollar, I'm sure you have that available. You have seen the euro stay in an 86 pip trading range, in a narrow trading range. So yesterday was a day. It was a holiday in the United States. So it was a kind of day where you can almost anticipate that the market was going to be a swinging bachelor type of trade, where you had to trade, buy the dips and sell the expensive. And as long as the market, so that was yesterday as a trade. On Friday, the market also, really on Thursday afternoon, when the market started to reach its bottom, is when the market started to correct to find a 86 pip trading range, which we've been in since that time, and still since just right now, I guess, when the market's broken to new highs. But in those types of markets, you want to think about being a swinging bachelor. When the market's not acting, it's not trending or showing the signs of the trending market. It's not holding the 38.2% retracement level or the 50% retracement level. It's not holding the trend line. And so at those times when the market doesn't act like a trending market, You have to start to think in terms of a swinging bachelor. You have to think in terms of getting out of that long position or short position when the market goes for the 50% retracement level and say, the market's not trending. I've got to think in terms of being in a swinging bachelor type mode where I'm going to be trading the long and the shorts and start selling highs and buying lows until that time when the market breaks out. So being aware of the fact that markets trend and they non-trend and looking for clues from the markets, from the technicals, will allow you to become more of both a swinging bachelor and a devoted lover at the same time. Next mindset of a Forex trader, a fear conqueror but a greedy bastard too. What do I mean by being a fear conqueror but a greedy bastard too? Let's look at the fear side first. In order for you to be successful as a trader, you have to have the mindset that you can conquer your fear. You have to have the mindset that your fear is not an issue. Fear is a trader's worst enemy. If the trend is your friend, fear is a trader's worst enemy. It will make traders do things that they normally would not do. Whether you're, and it goes true for anything in life, whether you're, anything. If you have too much fear, you're not going to do well. If you have fear of marrying a girl, that wedding is not, or that marriage is probably not going to be a good marriage. Let's call it like it is. If you're fearful of a shot on a golf hole because there's water in front of the green and you're fearful of hitting the ball in the water, you're going to hit the ball in the water. Traders who have fear are going to be more inclined to cut their wins way too short. Way too short of the trend. You're not going to stay on the trend. You're going to be too fearful of that position. Traders who have fear also are going to likely either cut their losses quick, but also have the potential to keep the losses open longer. They fear that if they cut their position now, the market's going to turn around and go back in their favor. When I was at a webinar in Dallas, someone talked to me about that. How they got into a position that was based not on anything where they defined risk or limit risk or use any technical tools. It was just a fundamental play, and they ultimately kept that position open and feared for the rest of the position till that time where they finally feared themselves out of the position right at the low of the market, and they got out and the market rebounded right the other way. So you as a trader have to conquer your fear. You have to make sure that you conquer your fear in a proactive way. And if you do that, you'll think more clearly, do your trades will become more disciplined, or you're in a position to trade more trends. That is one of the mindsets that you as a trader have to do, is conquer more fear, and I'll talk about that when I get to the next one, how you go about doing it. The other thing is, the other side of the coin is not only do you have to conquer your fear, but this goes against most of the grain as well, because most people think that fear and greed are a trader's worst enemy, that if you're too greedy, you're not going to be good as a trader. This is where I go a little bit off and say that the mindset of a trader needs to be that you have to be a greedy bastard at times as well. Bulls and bears make money, but pigs get slaughtered. Is that right? No. Wrong. All right. If you take the attitude that bulls and bears make money, but pigs get slaughtered, you're never going to stay on a trend, and you're never going to have your account balance get big and fat. So, my friends, you have to have the mindset. If you're in this market to make the most amount of money that you possibly can in trading, you have to have the mindset of being a greedy bastard at times. You need to go out there, and you need to think in terms of being greedy and selfish. And if you do that, you're going to lead yourself to trending profits. And that's where most of the money is in your trading. But where greed gets in the way, my friends, if you start using your greed with a losing position or a trade, if you're thinking in terms that I'm going to make money on this trade, I'm going to be greedy, I'm going to take money, but you have a losing position, that doesn't make sense to have greed, does it? It also doesn't make sense to have greed if the market is showing signs that it's topping or bottoming. It's showing signs where the bias is turning around. Again, in your mind's eye, imagine the market trending to the upside. The market is giving all the clues that the market trend is continuing. We're holding the 38.2 to 50% retracements on all the retracements. We're staying above the trend line. We're staying above the 100-bar moving average on the 5-minute chart and the hourly chart and the daily chart. All these things are working in their favor. That's where you want to be You want to be greedy in your position. You want to keep that position. You want to follow that position, hold that position until the time where the market says, get out. And where does the market say get out? It doesn't say it at 40 pips, some random number of 40 pips. It doesn't say it at a random number of 60 pips. It doesn't say it at a random number of 80 pips or 100 pips. It says it when the market tells you that the bias has turned from bullish to bearish, that the price has moved below the moving average line, that the price has moved below the 100-bar moving average on the 5-minute chart, or below the 50% retracement of the last leg to the upside. That is where the greed disappears. And if you hold your position through those times when the market is telling you get out, then you're being greedy. Then you're being greedy, the bad greedy that you as a trader cannot afford to be. You have to be greedy when the market tells you to be greedy. You have to take your greed and get rid of it when the market tells you not to be greedy. Have that mindset, ladies and gentlemen. Have that mindset about greed. That greed can be good, but greed that is abused is bad. And so understand when to be greedy, when to be that greedy bastard, how to do it, and do it until that point where it tells you otherwise. And also conquer your fear. We'll talk about fear right now in the last session, which talks about being a risk taker and a risk avoider. Folks, you have to be a risk taker. If you're not concerned about, or if you're not interested in taking risks, then you're not going to be good as a trader. However, risk should always have limits. Traders who focus on risk and limiting the risk are smart risk takers who are managing their business's bottom line. Your losses as a trader, think of as your expenses to your business. You are not going to not have a business that doesn't have expenses. But those expenses, just like in any other business, need to be limited. They also need to be defined. And if they aren't, those losses or expenses can be unlimited. So you as a trader have to take on risk. Yes, take on risk, but understand there are limits to your risk that you have to take. And the best way, what you need to focus your mindset on is making sure that you define your risk and limit your risk against key technical levels. Levels that you can define, levels that you can use, like the 38.2 to 50% retracement, like the 100-bar moving average, like a trend line. Any sort of technical level that's going to define your risk. That is where you take your risk at, against those levels, and hope that the market goes in your way. And if it doesn't, get out. But and limit your risk. Be a risk taker, but limit your risk. And so you have to avoid risk at the same time. And when I mean, avoiding risk comes by defining risk and limiting your risk. But it also has to do with the other aspects of risk that we face in trading. When you think about defining your risk and limiting your risk against a technical level, that is defining risk and limiting a risk against what is called market risk. Market risk is what we face every day when the market moves to the upside and to the downside. That market risk can be hedged away by defining risk and limiting risk against those key levels. And by the way, if you do that, you're also able to control your fear. Because if you know that your risk is limited, that your risk is defined, your fear should go away, right? And so that's how you become a risk conqueror, is by defining risk and limiting risk. Now that is market risk. There are other risks in the market, including event risk, liquidity risk. These are the three main risk ingredients that we as a trader face. Market risk can be hedged away by defining risk and limiting risk. Event risk and liquidity risk can be avoided most times. For instance, you know that the unemployment report is coming out at 8:30 on a Friday, the first Friday of the month in the eastern United States. That is that you can avoid that risk. You can decide not to trade because event risk is increased. We don't know what the employment number is going to be. We don't know what that number is going to be. So why put yourself at risk for that event? And so you have the opportunity to hedge yourself by not trading. And you have to be a smart trader and say, this is like a betting red or betting black on the roulette table. I don't know what the event's going to be. I'm going to avoid it. So you have to avoid those types of risks. Those types of risks where the event risk is increased, where it's in the red zone. If you have a scale of green, yellow, red, you're in the red. Avoid it. And when there's typically event risk, there's liquidity risk as well. And so you have not only market risk, you have event risk and liquidity risk. During those times, I say change your mindset. Understand that this risk is too great, and that it's okay to not trade during these times. To wait until the event risk and liquidity risk is over and then trade. That is what you as a trader should do. That's a mindset that I think you as a trader have to face and realize in order to be successful in your trading, because those days where the event risk and liquidity risk are great, you may win sometimes, but you may lose big sometimes. And those big losses are the ones that take you out of the market. Also, another time when you want to be a risk avoider is when the markets aren't choppy or not trading normally. There's always going to be another trade where there's less risk. If the market's choppy or not trading properly, get out. Don't trade. Look for those opportunities where you're feeling a little bit more comfortable with how the market's doing, what it's doing. Change your mindset to understand that. All right, so that ends my lesson here today. I apologize for not being able to show you the pictures that I wanted to do. Was I not prepared? Maybe I should have had the slides or the pictures of the charts in my PowerPoint. So I apologize for that. Maybe it is my fault. But I think that I wanted to go into this session, this special session here for FX Street, to kind of to talk more to you as opposed to show you how. I do believe that the Trader Foundation, understanding what you should think as a trader, have a mindset of a trader is important. Understand what that means, what type of person you need to be, what type of personality, character traits, what you have to think of, and how difficult it is. But if you understand what you're trying to do, you have a better chance of doing it. Okay? If you understand that you have to be a risk taker and a risk avoider, and you know what that means, you're going to be in better position to go forward with it as well. If you understand how you can be a winner and a loser at the same time and understand the emotions of that, you're going to be okay. If you understand what being disciplined and aggressive means, you're going to be okay as a trader. You're going to be more successful. So I hope enough of you took something out of that. And I apologize again. I'm going to be working with the people at FX Street to understand fully exactly how I can incorporate both the PowerPoint and the slides without having to get out of everything and start everything open. That's not the best way to do it. So thank you very much, everybody. I really appreciate it. Thank you to the people at FX Street. You're the best. You do a great service for everybody. And good fortune with your trading. Let's get back to that market. Is Euro moving higher still? It sure is. We've extended that trading range. Have a good one.